Hello, everyone. My name is Roberto Pasqualino. I am a visiting researcher of the Global Sustainability Institute in Cambridge and developer of the Economic Risk Resources and Environment System Dynamics model. This was done under the ESRC research project CASP, that is the Center for Understanding of Sustainable Prosperity from 2016 to 2019, and the Global Resource Observatory project funded by the Peter Doe Foundation from 2014 to 2016. In this presentation, I'm going to give you an overview of the structure of the work of the ERRE model. This lecture starts with quickly describing the pre-existing model frameworks that were used to develop the ERRE. Then I will provide an overview of the model and major sectors that compose it. I will provide a bit of insights on the production sectors, describing the way a model financial decision-making and assure financial stock and flow consistency in the model. I will show the major feedback loops that link resource constraints to financial risk components in the model. And then I finally explain which economic theories lie behind the model and why. The beginning of our modeling journey started from the research of Professor Forrester, who is also the creator of system dynamics. After the work on the limits of growth and world dynamics of the early 1970s, he put his efforts in the development of an economic model of the United States economy that he called the System Dynamics National Model. He started by involving many PhD students, first among all Nathaniel Mass, who proposed a study of business cycles using this model as PhD thesis in 1975. This was followed by Peter Senge, who worked on the investment function of the model. Then John Sterman, who proposed the energy transition model based on this framework, and among the last we find James Hines, who focused on the interest rates. Among these, the work of Sterman in 1981 became the base for the development of ERRE. Sterman used the generic structure of the national model to look at the potential effects of the energy transition of the United States economy and inflation after the peak oil shock of the 1970s. The objective was to move from what he called conventional energy, that is cheap oil, to unconventional energy, that is more expensive, non-renewable resources that could be considered as not reaching limits by the end of 2050, that is the time horizon of his simulation. As a result, he added an OPEC sector to model their potential strategies on setting oil prices, such that he could assess the best responsive strategy for the stability of the United States economy. Since the ERRE is a global model, among these structures, we picked all but the OPEC sector that we could integrate among the others. Secondly, after a detailed study of the limits of growth over 303 model, we consider that pollution sector and the resource sectors as inadequate for the ERRE purpose. So we decided to only use the land structure of the model as base for the food sector of the ERRE and included that alongside other elements of the Sterman model, linking it to the rest of the economic structure. The ERRE is the result of 6 years investment, first from the Global Resource Observatory project from 2014 to 2016, and then with the ESRC Center for the Understanding of Sustainable Prosperity CASP project from 2016 to 2019. As we said, we start from the World 303 model and the energy transition and the economy model of John Sterman in 1981. Then, of course, lots of edits were made, including the modeling of the connections between agriculture and bioenergy, the green energy sector, and we added a climate module. In addition, we improved a lot of structures of the energy transition and financial sector that resulted being outdated for the aim we had. This included the modeling of the default system, connection between households, banking, and governments, and made the model as a closed-loop financial stock and flow consistent model. The model is today published in the book Resources, Financial Risk, and the Dynamics of Growth, Systems, and Global Society that we published with Professor Aled Jones. All equation and testing, as well as computer model, are freely available online at the link aru.ac.uk/people/Roberto Pasqualino, that you can find also by searching for myself on the Anglia Ruskin University website. To give a definition, the ERRE can be considered as a globally aggregated impact assessment model developed to address the risks emerging from the interaction between economic growth and environmental limits under the presence of shocks. This figure shows the top-level view of the model, highlighting what we keep as exogenous and what as endogenous. In particular, on the left side, we see that we use labor productivity as a proxy for technology development and population as exogenous variables over the time of the simulation. The reason for this is the high uncertainty of these elements that could not provide real value to the model to create a fully endogenous structure for these. As shocks, we can consider both environmental shocks on the left-hand side as well as policy shock from the government and financial sector, such as push for money creation, changing interest rates, or tax changes. The exogenous structure is quite detailed, including firms that trade among each other and modeling variables such as prices, debt, or wages for each sector. Also, labor market and the energy market were included. Firms deplete the environment by operating which can feedback negatively onto the economy through climate effects, resource scarcity, or land scarcity. The financial sector, that we refer here as the banks, and the government sector, that we refer to here as public sector, include the standard structure at the very aggregate level that include receiving taxes and paying expenditure, create money endogenously, or changing interest rate with an endogenous structure. If you give a closer look at the architecture, we can discern at least three main networks that break the hierarchy of the model. At the top level, we find the connection between household, banks, government, firms, and climate change. At the second level, we disaggregate firms in a closed-loop supply chain in which all firms generate demand for the others, that plan a capacity and produce accordingly. At the third level, we differentiate among the three energy sectors of the model that are fossil fuels, renewables, and nuclear, and biofuels, which compete to produce energy. All firm sectors are the largest part of the model and have a similar structure among each other to simplify the design. All sectors are based, all sectors are based on the principle of boundary rationality and bounded resource limits. All the financial flows are depicted using double entry rule on their balance sheets, generating a closed-loop financial stock and flow consistent economy. Going deeper, looking at the main interaction in the firm sector, we see they all need to hire people and buy assets for production. Thus, they manage demand using an order backlog. Prices and wages are based on this connection as well. Production feeds to the inventory and get delivered to the customers. They all plan their finances based on debt, generate profit, pay taxes, and have their own sectorial interest rates. All the real flows are also represented in terms of financial accounting rules, as we will see in the following slide. This is the balance sheet adopted in the firm sector. As you can see, all transactions are recorded using the double entry rule in both assets and liabilities side. All flows represent the cash flow statement of a company, and the stocks accumulate their differences, highlighting assets value and liquidity on the asset side, and debt and equity on the liabilities side. Cash and liquidity are differentiated such that in a stock and flow consistent model, one wants to keep the cash stock flowing at all the time. So the value of that particular stock remains at zero while accumulating all the liquidity via return earnings and losses. As you can see, the balance sheets give a great overview of the sector. Each of the elements here represent the financial measure of some real elements underneath them. For example, sales for revenue or payments for energy for the actual energy consumed in a firm. Linked to the previous slide, I showed the use of a nonlinear relationship to model financial decision-making to control the cash flows in the model. You can imagine you're a financial manager of a company and you need to assure your liquidity never drops to zero. You find a connection between the stocks of cash and liquidity as in the previous slide, where the cash inflows are things like revenue and borrowing, and cash outflows are all the expenditure and investments. On the left side, you can see all the functions of the company that require cash to operate. For example, you can have a request from the human resource manager asking for a certain amount of wage payments, or the operations manager seeking investments to assure the capacity matches the required demands. Also, you have other costs such as energy payments or taxes. The sum of all of those generates the desired payments. The desired liquidity is thus determined by assuming a certain liquidity coverage based on payments. For example, if a firm has £1 million of desired expenditure, it might require to have a general £200,000 as available liquidity to overcome the risk of default. As seen in the case in the standard use of nonlinear relationship in system dynamics, a liquidity adequacy is the ratio between actual liquidity, the stock, and the desired liquidity. Liquidity adequacy is given as input to all the individual nonlinear relationships that act as a multiplier on each individual desired payment. As you can see, the nonlinear relationship all constrain the payment at zero when liquidity is zero, showing that a firm cannot accept any request for payment unless they have liquidity. When the ratio between liquidity and desired liquidity is 1, then the multiplier is always 1 as well, meaning that they can allow for the full desired payment to be done. When they have a liquidity surplus, then most of the nonlinear relationships stay at 1 as well, meaning they will also generate exactly as much payment as they need to. However, in case of liquidity shortage, and this is the interesting part, the nonlinear relationship go towards zero with a different shape. This indicates that it is possible to give a firm, to consider that a firm can give priority to certain items above other for payments. For example, the tax curve stays at 1, way below liquidity shortage, meaning that the firm must pay taxes no matter what. Instead, they would prioritize maybe reducing investment quickly to balance the liquidity out. The good part of this formulation is that it could allow for a variety of behaviors of managers, including irrational behavior of panic in case of liquidity shortages. For example, by making labor payments going to zero more sharply would indicate a behavior of a manager that will be more careful about hiring more people and so on. This is what in behavioral economics is called the anchor and adjustment heuristic, where decision makers anchor to a desired value, then constrain payment to stay close to it. This slide shows the balance sheet of the financial sector in stats, that in the ERRE is the aggregate of all banks and central banks put together. As you can see on the right-hand side, the two stocks of liabilities are the household's saving deposit and what we call here as tapped money. This was chosen to highlight that the financial sector can print money out of nothing and lend them as loans to the real economy at the cost of interest rates. On the asset side, you find that we use the Basel III structure for assuring solvency in the banking systems, including liquidity, reserves, and loans as total assets of the bank. Finally, we assume here that when government creates debt, that can be owned by the financial sector by purchasing and selling securities and bonds. Going back to the firm sector, we show here the modeling of interest rates that in the ERRE is seen as the basic financial risk measure used by the financial sector to determine the cost of servicing debt. In ERRE, the firms connect the natural resources such as land and fossil reserves to the real economy, capital and labor, to the financial element as we said before. A reinforcing feedback loop is used to change interest rates and defaults in the economy. In particular, it is assumed that an increase in liquidity would decrease defaults. Of course, this is also true that a decrease in liquidity would rise the default rate. When defaults increase, interest rate will rise to balance the increased risk of the sector, such as the cost of debt. So the cost of debt will increase as well, thus reducing the liquidity. Reinforcing loops can act both increasing liquidity or decreasing it based on the dynamics. In fact, when liquidity rises, defaults will decrease, ultimately reducing the cost of operation and supporting higher liquidity. On the other hand, if liquidity drops, defaults would rise, increasing cost and decreasing liquidity even further. If we expand this rationale a little, we find that the same reinforcing loop is balanced out by other forces. In fact, higher liquidity supports higher investment, production capacity, and labor. This generates more demand for debt, which will ultimately increase cost as well, reducing liquidity. On the other hand, higher capacity means more payments for maintenance and labor, thus increasing costs further and reducing liquidity. If we expand the picture even more, we find that prices and production are all connected in the model to interest rates and liquidity. In particular, higher capacity means more production, more inventory, and give availability for higher sales. The imbalanced inventory can increase price that will then support higher revenue and more liquidity. As you can see, in normal operating conditions, more liquidity brings more liquidity overall, thus bringing defaults down and interest rates down as well. However, if one applies an environmental shock that normally has the effect of reducing capacity of production, then all the feedbacks will revert their effects. In particular, a reduction in production means lower inventory and constraints for sales. This will reduce revenue and that will reduce liquidity and activating the reinforcing loop of interest rates increase over time. This will balance out only when demand decreases for the higher price or when the firm can start operating again in aftershock condition. This structure is one of the main elements of the limits to growth to link resource use with what we put in ERRE as the financial risk. In the book that I wrote, there is an entire section on the understanding differences existing between economic theories to demonstrating which ones the ERRE fits into. One thing that we can say is that when modeling things using stocks and flows, it is very simple to end up in each economic school. Most often, and in particular when nonlinearities are not used, one can easily develop a general dynamic model in line with general equilibrium theory and neoclassical approach. In the ERRE, there are in fact some neoclassical elements that include the use of the production functions and exogenous technology change. However, and as stressed in this presentation, we can say that in this model, there are many other elements of evolutionary economics and behavioral economics school of thoughts. In particular, with evolutionary economics, we mean the existence of path dependencies in the system that are normally neglected in general equilibrium theory. In this model, for example, prices are not modeled as computing equilibrium between supply and demand. Rather, they are modeled in a system of pressure that will ultimately make customers to partially adapt to the new price as a new normal, leading to not to an equilibrium approach at all. The behavioral economic element is dependent on the many perception time delays in the system and all the nonlinear, often asymmetric decision behaviors adopted in the model. Some examples are seen in the financial decision of previous slides. The post-keynesian model is dependent on the use of financially stock and flow consistent economy, and the elements that we haven't seen in this presentation, including the economic response to money creation. Finally, the ecological element is of course present since we model resource limits in various ways. To give a summary, the ERRE was built upon pre-existing structures coming from the World 303 and the energy transition and economy models. A variety of updates were made, making this a completely brand new piece of work, useful for decision-making today. Some key elements of the model were shown, in particular the linkage between resource constraints and financial risk, that is a component often ignored by most economic models simply because shocks do not occur very often, but they will. Finally, we demonstrate how the model is a good piece of work for both behavioral and evolutionary economists, although including elements of post-Keynesian and neoclassical economists. Of course, the ecological element is now connected to the rest of the financial sector in the area. These are the references of the presentation. Hope you found this interesting. The next lecture will show the simulation analysis used with this model, hopefully clarifying many doubts and questions you might have.